You do the research, spot a setup, and execute a buy order, only for the price to stall out immediately. Sideways drift bleeds capital and triggers stop losses, often causing a trade to fail even if your directional prediction was technically correct. The market simply lacked the momentum to reach your target. This happens because most traders focus almost exclusively on predicting where a price will go, while ignoring the physical strength behind that move. J. Wellis Wilder developed the Average Directional Movement Index, or ADX, to address this specific blind spot by quantifying trend strength. To navigate these periods of uncertainty, traders need a way to mathematically measure the raw force of a move, independent of its direction. In this example, the price is crashing, yet the ADX is spiking aggressively. The indicator is tracking the intensity of the sellers, demonstrating that the index measures the power of the trend rather than the path of the price. The ADX operates on a scale from 0 to 100. Identifying specific levels on this scale helps define the current environment of the market. A reading below 20 indicates a weak, ranging market. During these periods, the lack of momentum frequently leads to the choppy conditions that trigger premature exits. When the ADX crosses 25, it suggests a trend is gaining sufficient momentum to likely continue, which is where many traders begin looking for entries. Readings above 40 show a very strong trend, but crossing the 50 level is rare. Markets reaching this height are often overextended and are likely reaching exhaustion. Monitoring where the indicator sits on this scale provides an objective basis for deciding when to risk capital and when to wait on the sidelines. While the ADX line provides the headline strength rating, it is the visible result of a more complex three-part system. The first pillar is the positive directional indicator, which measures upward market pressure. It works alongside the negative directional indicator, which isolates and tracks the pressure from sellers. When the positive line crosses above the negative line, the trend is considered bullish. The opposite crossover indicates a bearish environment. The ADX line adds a layer of confirmation by sitting on top of these indicators. It calculates if that bullish or bearish shift has enough underlying force to be worth a trade. This combination of directional indicators and a strength index provides a systematic way to verify a move before committing capital. Beyond entries, this data is used to manage existing trades by identifying a shift in momentum, known as divergence. If the price makes higher highs while the ADX makes lower highs, the trend is losing internal support. This suggests the high momentum phase is over, which often precedes a reversal or a period of consolidation. While these signals are useful, the ADX is not designed to be used in isolation. It functions best as a filter for a primary strategy, one already rooted in price action, deep volume analysis, or support and resistance levels. Mastering the ADX allows you to stop fighting stagnant market noise and align your trades with the dominant current of the price action. Open your charts and backtest the 25-level crossover on your favorite pairs. Practicing this discipline helps ensure that when you do enter a trade,